Yeah, I'm going to speak in generalities because obviously everybody's situation is a little bit different. So I'm going to speak to the majority of listeners. The majority, what would work best for the majority of listeners, and I have opinions on this. And my opinions may not be right, and they may not jive with what you want. So that's my disclaimer, right, Joe? But here goes. So what I would say is that for 90% of investors, the bulk of their assets should be contributed to their 401k or 403b plan at work. And yes, those 403 and 401k plans, they usually do not allow you to buy individual stocks. So you would have to buy mutual funds. Maybe you get lucky and you can buy ETFs in there, but probably mutual funds. And for most investors, that's really where the focus should be. And I get asked this a lot from students in the How to Talk Stocks class. They're going out, they're graduating, getting new jobs. What should I ideally be contributing to that 401 and 403b plan? And I would say, honestly, 15%, 10 to 15%. And most people will be like, but I was going to buy a BMW. That's my monthly payment.
Don't do that.
And I would say, don't do that. Drive the Toyota Corolla for a little bit longer. And, really, because time is on your side. I mean, every extra dollar you put in now, because of compound interest, is just money in the bank when you get to retirement. So,
and also just remember, nobody cares what kind of car you drive.
Yeah, nobody.
You do. That's about it.
Yeah, exactly. So, I mean, my goal, Joe, is to have a vehicle that reaches 300,000 miles. That's my goal. So I like to keep my vehicles, and I don't drive the flashiest, latest thing. I'd rather invest that money. It's just how I tend to view the world. Other people have different priorities, but I would say 10 to 15%. If you can't do that, say you do your math and you're like, oh, geez, I can only do 6, then make it 7. If I can only do 8, do a 9. If I can do 11, do 12, right? And then see if your HR department offers an auto escalation feature, which will automatically increase your contribution each year by X percent. So you could say, increase it automatically by 1%. I'm going to set it on autopilot. And then that way, when you get your raises, X percent is already going to go directly into the 401k. You don't have to think about it. You don't have to second guess it. You're not going to get emotional and say, maybe I shouldn't do that at this time of the cycle, whatever. Just hands off, let it go. And then honestly, for most people, depending on your age, if you're younger, tilt towards growth. And, really hard to beat an S&P 500 mutual fund. It really is. For the expense ratios, you're usually lower than growth funds. And you're going to get exposure across the business cycle, across the economic cycle. So you get early stage benefit from finance and technology. And then as it rotates, you're going to be able to go and you'll have exposure through S&P 500 to materials and consumer goods and energy stocks. So, I mean, I think that it's hard to beat that. I think from an individual side, we do have subscribers who use the sector rankings that we put out and the industry rankings that we put out to do an aggressive ETF strategy. I think that can play out pretty nicely. So when in our sector ranking, if technology scores very well, then you could own the XLK or the IGV ETF. If healthcare scores well, you could own the XLV or something like that. Just pay attention to expense ratios, because on ETFs, you can find, differences of 10 basis points to 20 basis points on sector and industry ETFs. And hey, if you don't have to pay that as an expense to, for the fund manager, better have it and leave it in your pocket. So all things considered, not all technology or healthcare or energy funds are created equal. So take a look at the holdings and make sure you're comfortable with the top 10 or 15 holdings that are listed in those ETFs, because they may be different from ETF to ETF. And you want to make sure that if you're buying a consumer discretionary ETF and you're not really comfortable with it having its biggest position GameStop, maybe you would want it to be a different consumer discretionary ETF. So pay attention to the top holdings and pay attention to the expense ratios associated it. And then you can, like I said, use our rankings to help you navigate into the specific industry or sector ETFs that are scoring best for us at any given point in time. I will say that we did, Joe, back in the day, crunch numbers and found that most of the majority of the return of the S&P 500 came from financials, technology, healthcare, and energy. So if you wanted to have maybe a more aggressive S&P 500 hands-off kind of approach, maybe pick those 4 ETFs and just let those ride. Or if you have access to sector mutual funds in your 403 or 401k plan, consider those. So that's just random thoughts on the subject. Not sure if I answered the question for you, listener, but hopefully it gives you at least some things to think about.
Yes, I hope so too. One thing I would just add is, if you just started a Roth IRA, I assume you're fairly young. Your your profile picture looks like you're fairly young. So I would encourage you to do a little research on mutual funds that may target like green energy or something like that, just because in the next 10 years there's sky is the limit for stuff like that. Green energy, I would also put like space in there, not SPCE, but a space related ETF or mutual fund, just to give it a look, and see how your whatever broker you have, whether it's Fidelity or Schwab or any of them, they should all have like some sort of rating system that'll show you, and you can compare their returns over time compared to the S&P's returns and stuff like that. So if you find a mutual fund that's green energy or something like that, and you see that it's been around for 15 years and the average annual return is 40%, go for it, man. I mean, not going to say put all your eggs in that basket, but I think that's also a great way to kind of branch out and diversify.
Yeah, I think as long as you're going in with eyes wide open, recognizing that it could be volatility, and it could be more volatility than the S&P 500 mutual fund, as long as it's money that you don't need within the next 3 to 5 years, then yeah, why not? The other point that raises, Joe, and I think it's a good point, is that the temptation as investors is that I'm going to pick the one winner. Well, oftentimes in emerging areas like space or green energy or machine learning or quantum computing or whatever, it's very hard to, or even if you look back to marijuana or betting or whatever, it's hard to pick the one. And what an ETF allows you to do is get a basket exposure. And the one that jumps to mind right now is like ARC Genomics, ARC-G, giving you exposure to all those genetic testing plays and the genomic biopharma companies. So rather than having to pick the best one and being wrong as a binary event, there's value, I think, in taking that basket approach and relying on the professional manager and paying a little bit more in expense ratio for that. But I think it does make sense to do it.
Yeah, the last thing I would say is, if you're going to go for that kind of I guess we could call it an aggressive ETF or mutual fund strategy, don't look at your portfolio every day, because you're gonna see especially on a good day, you might be up 1%, and your best mutual fund might be up 3%. You're thinking awesome, and then you go into the specific holdings and say it's the SPY, just to use something that we're all familiar with. And then you go into the SPY and you see, oh, but Tesla was up 12% today. And you're just going to be hitting yourself over and over again. But over time, you will do better than you would with an individual stock. And so when Tesla goes down 12%, you're not going to go down with it.
Yeah, it's almost about the smoothing of returns, right,
Exactly,
Joe? It
exactly.
smooths the returns.
That's
And I
all.
think you should
That's
be
all
okay.
diversification is just making, being a little bit more risk averse and risk tolerant.